7 trading days in a row in which we've alternated our closing price. Up, down, up, down, up, down, up. It is pretty difficult to get a feel for what your short-term trend is when you've got that kind of alternating activity. Intermediate term activity clearly is now bullish. So this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is currently 7:27 a.m. Central Time, and I'm recording this in preparation for the market day of March the 23rd, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive in and see what happened in our overnight. Well, at the time that this snapshot was taken, we were down just teeny bit, and really markets generally pretty much scratch across the 4 broad market index futures. Now crude oil, that's different. Crude oil is down about 2%, pretty significant move down on crude oil. You have the euro up about 0.7. You have bonds absolutely scratch, as you kind of would expect with the broad market indices being essentially the same. Gold down about 0.3%. So not an awful lot there to focus on. Crude oil, of course, continues to be its own story. In overseas action, China up almost 2%, Hong Kong up about 0.5%, Japan up about 1%, so Asia very strong. On the flip side, though, that did not carry over into Europe. Germany's down 1.42%, and the FTSE is down about 0.3%. In terms of macroeconomic reports for today, you have an FOMC member speaking. You have existing home sales at 9 o'clock Central. That's an orange flag report. That looks to be about it in terms of U.S. macroeconomic reports. In terms of tomorrow and what to expect there, you have CPI. So we got some red flag reports tomorrow morning before the market opens. And let's see if there's anything else. Flash manufacturing PMI after the market opens. So that could kind of roil things a little bit. And new home sales and Richmond Manufacturing Index. So a number of things for a Tuesday. Not too much on the ladder for today. In terms of current volatility, obviously we've been kind of dropping, and you notice the Russell's still sitting here at a 0. That means that the historical implied IV percentile being a 0, that we've not been any lower in the last 52 weeks. So obviously it can only go up. Now that doesn't mean that it has to go up today. Volatility can remain low for extended periods of time, and indeed right now you have all 4 of the broad market indices in the bottom 25 percentile, so pretty low. Now standard deviation moves, this is often to me more telling as to what kind of real price volatility we're dealing with, and that is to say that we have had more than a 1 standard deviation move in all 4 of the indices on Friday. And you notice this, I mentioned it at the top of the broadcast, you know, these alternating days. Well, we've also been alternating kind of standard deviation moves. You have a big move followed by small move, big move, small moves, big move, small move, big move. So it's really required, probably you could say this for pretty much all 2015, a very, very nimble trading circumstances for day traders. Been pretty good conditions, but for swing or intermediate term traders, this has been pretty difficult because as soon as you get your all clear, your initiations to go in, you hardly get any follow through before things seem to go and start ripping the other direction. It is obviously in the intermediate, longer intermediate kind of time frame, though, we still are in a bullish trend. Let's get down into the regular daily report. Gold futures will be the next contract that will roll over probably towards the end of this week, so you need to keep an eye on the volume in the front end month versus back end month for your gold futures. Obviously, market trend, our intermediate term phase opinion still remains phase 3, higher highs and higher lows. We are within about 1% of setting new highs on S&P and the Dow. I believe the NASDAQ is within 2%, if I remember the number correctly. Russell has already set a new higher high, and we will feel better about this market term intermediate phase opinion when we get this newer high, because we have a lower low without a higher high on a couple of these markets, and we need to establish this stronger bullish tendency. Portfolio posture, we did see a change here. IBD status was elevated to uptrend resumes. We do have some cautionary factors still in play, and I'll get into that in just a moment. But from an investor posture standpoint, both IBD and the GMI index are as good as it gets. And you put that with the market posture. Our active trader market posture is bullish as well. So you have position sizing opinions coming in for both the investor position sizing as up to 100%, and from a volatility based active trader position sizing opinion as up to 100%. So this is about as clean as it gets, on this part of the report. Market timing opinion is neutral, and indeed we've kind of had this alternating action in recent trading sessions. Very hard to have any kind of edge on either of the 1 or 3 day outlook when you look at that. As we mentioned earlier, though, if you go out to a longer term, more intermediate term kind of time frame, then you go back to your bullish posture. And indeed, market forecast posture opinions is bullish. You see the S&P 73.6 and up. Dow the same. NASDAQ and Russell both are in the very bullish posture stance. So really very, very clean there. Now this is where we start to see some little bit of flies in the ointment, and you notice that we still have left the threshold level as 0 plus, normal with elevated factors. I debated whether to drop this to a 0 today, and did not for a couple of reasons. One is we still have a number of these warning flags from our various inputs, and number two, our history in recent weeks has been that as soon as we give the all clear, we have a pullback. And so I'm going to be just a tad more cautious here and see if we can't truly establish a clear bullish trend without all of these warning flags before dropping this to a full 0 and calling it normal bull market conditions. From volatility based, you see the primary warnings come from the number of distribution days, relatively high here with 5 at both the S&P and the NASDAQ. We also had a volatility ratio warning fire off at the end of last week. I mentioned this a moment ago. In the intermediate term, the S&P, we still are sitting there with a lower low. We need a higher high, and we have not yet gotten that, though we are very, very close. Some very healthy things, though. Obviously, Friday, look at this new highs, new lows on the New York Stock Exchange, 521 versus 69 on the 1 month time frame. So that was a very strong signal. This is another reason for the 0 plus. The intermarket risk aversion indicators still show a number of risk off or at best neutral kind of postures. So we've got, when you add all this together, we've got 1, 2, 3, 4, 5, 6 different kind of warning flags that are saying that maybe we're not a full-fledged kind of full-on, risk-on kind of posture yet, and that's why I've left the hedge risk level status as 0 plus. Now, that's still pretty strong, and clearly with position sizing opinions coming in 100% and so forth, you are in a pretty good position to initiate new short-term or intermediate-term bullish positions when you get your setup triggers in place. From an option income strategy, VIX is inside the acceptable window. Very much all go for initiating new option income strategies. Cover call strategies, still a tad conservative here, calling for an equal distribution between in the money and out of the money strikes. And this is also in part because of the obviously the Fed is going to start raising interest rates in the coming months, and whether that's 3 months or 6 months, obviously covered call strategies, while many times you put those on and you peel them back off within a month or so, that is more of an intermediate term strategy, and we could have some significant movement with the market direction in this year with the increasing activity by the Fed. Put selling, that's a much shorter term kind of time frame generally, and we are still bullish. So acceptable to sell puts against a core portfolio basket of stocks that you're willing to own in the position size that you are actually willing to own. If you go more than that, then you enter into the speculative realm, and at that point, then you've got to kind of exercise a different set of criteria. In terms of relative rotation, you see XBI, the biotech, and the semiconductor and home construction are really probably the primary players in terms of being healthy. We'll see this couched in a slightly different way in just a moment, but I know an awful lot of the things that are on my watch list right now come from these three sectors. So this certainly reinforces that feel. From a point and figure, members, you'll probably want to dig into this report a little bit deeper. But obviously, we've had just one change here from the prior week, so I'll let you dig into that in more depth. Sector market posture, look at this, much more green here, though we still have some concerns. Consumer staples, pretty neutral all the way across the time frames. Energy continues to struggle. Materials continue to have a hard time. And then, of course, utilities has been really hammered in the early part of this year, though it does seem to be improving, and that's going to be a reflection of interest rate expectations. From a sector percent change, obviously very green on the 1 day, and indeed on the 5 day, you're starting to see perhaps building some consistency. While we've been this alternating pattern of up and down, obviously the up moves have been more significant than the down moves in recent trading days, and we're starting to see this reflected. And indeed, energy, which has been hammered so hard in recent trading weeks, has actually put in a 5 day time frame up 3.38% there now. Utilities also up 4% in the 5 day time frame. So materials probably being the least consistent performer during that kind of time frame. In terms of primary industry groups, retail's now risen to number 1. Internet, railroads, biotech, healthcare, transportation lead our industry groups. And I think there's probably quite a bit of things to look for in semiconductor and biotech and healthcare. Probably are some very interesting plays in some of those sectors right now. Let's see, that should pretty much take care of us for today. A little bit longer. We've had a number of changes to our report structure today. But as always, if you like what you're hearing here, we greatly appreciate you taking the moment to invest back in us by showing that you like us on YouTube or your other favorite social media platforms, and share with your fellow trader community. As always, emails and other commentary can be sent to support@falconglobaltraders.com, and more information about our day trading tools such as the daily price guide and other reports are available at the website falconglobaltraders.com. Disclaimers as always, hit the pause button, and if you need more time to read this at your leisure. And we greatly appreciate you each and every trading day here in the Falcon Global trading community. We'll see you here at the same place, same time tomorrow morning.